and banking and pharma, in fact, took down its full-year outlook. So far this year, shares of Cognizant are up about 9%. In today's session, they are plummeting, though, by 15.5%. Here first on CNBC is the company's CEO, Francisco D'Souza. Francisco, it's always great to speak with you.
Good to be here.
I want to get some color on some commentary that you made that is spooking the markets, and that is that you're seeing slower than anticipated acceleration in demand as we entered the quarter. Can you give us color as to whether or not that has persisted to date and where that weakness is coming from?
Yeah, we had a very solid first quarter. A normal seasonal pattern for Cognizant is that we would expect to see an acceleration of growth as we wrap up the first quarter and come into the second quarter. And while this year we did see that acceleration, it was not to the level that we would have expected, given where we were previously expecting the full year to turn out. So based on that, we decided to take a cautious approach and reduce our full year outlook for the year.
What are you hearing? I'm sorry, Francisco. What are you hearing from your customers out there as to why that slowdown is happening? A lot of other analysts out there are saying, you know what, we're going to come up upon a fiscal cliff this year. Is that part of the reason?
We're seeing the lack of acceleration principally in two parts of our business. The first is in the banking portion of our financial services segment, and the other is in the pharmaceutical portion of our healthcare business. What's happening in those two industries in particular is that, as you know, those are two industries that are under a considerable amount of pressure right now for a variety of reasons that include macroeconomic reasons, cyclical changes, and secular changes in those industries. And our clients are slowing discretionary spending in those industries, taking a more cautious and wait-and-see approach to discretionary spending and being more prudent in their spending patterns. So we're really seeing the weakness in those two principal areas of our business.
Francis, I'm struggling here. The reason why I'm struggling is because SAP, which I follow very closely and it's going to be on my show a bunch of times, Accenture, IBM, they're all saying that it's not discretionary, that it's absolutely necessary to hire them. All of them have said that the areas that you're citing weakness in have been strengths. So naturally, one may conclude that you're losing share. I don't want to say that. That is what someone might say. I'm not saying that, but I'd love to hear your comments on it.
Yeah, I think it's very, very important to put our results into perspective. We grew faster than virtually any of our peers in the first quarter of this year, and our revised outlook at 20%, at least 20% year-over-year growth for the full year, is still at the very top of our peer group. So we continue to believe that we're growing faster than the industry, faster than our peer set, and taking market share. So while we're disappointed that we took our outlook down a little bit, as a result of this lack of acceleration that we saw coming into the second quarter, we're still very confident in the strength of our business model and the fact that we're taking share considerably as we go forward.
So, Francis, you're obviously saying that the stock down 10 is ridiculous. I'd love to hear, who'd you take? You took share. Give us some names, because it's very hard to dislodge an SAP or an IBM. So if you give us some names, I will feel so much more confident about this share take issue.
Well, when we look at our primary set of competitors, we look at the global IT services firms, the firms that provide software services around some of the firms that you mentioned. For example, we have a very solid business in SAP, in implementation of SAP. And so when we look at our peer set, we look at the global IT services firms, firms like SAP, like Accenture, firms like IBM. That's really the set of firms that we compare ourselves with.
Mr. D'Souza, final question here. To the extent that you cite secular changes in banking and pharmaceuticals, does that mean that there are secular changes in their ability to spend money on your services?
I think that any business that goes through secular shifts, or rather any industry that goes through secular shifts, represents a long-term opportunity for us. As our clients go through secular shifts, in general, they need to deploy technology in new, creative, and innovative ways. And that's where Cognizant can really play a significant role.
And Francisco, let's be clear here. When we're saying secular, and you gave us a list of different factors, is this regulation, a changing industry here, the elections coming up, the uncertainty of the elections and regulation? What is this? What are we talking about?
I think it's a combination in those two industries. It's a combination of underlying industry dynamics like the patent cliff that we're seeing in the pharmaceutical industry and regulatory changes as we're seeing in the banking industry.
Okay, Francisco, thanks so much for your time. Always great to speak with you. Francisco D'Souza of Cognizant. Cognizant shares right now down 15.5%.
Tough, Melissa. Tough,
yeah.
Right, David? Because you wanted to hear customers that switch. We don't think of drug companies as companies that are
need to cut back.
I know, but you don't. I mean, he clearly countered your assertion that they might be losing share by saying they're gaining share, but didn't give us any obvious.
I always like specifics. I feel so much better.
Yeah. All right. We've got to take a break here. 6 and 60 is up next.
Hello and welcome. We have someone special with us, Francisco D'Souza. He's been pretty much scoring well on the Cognizant quarterly revenues front. Francisco, thank you for joining us. Take us through the numbers this quarter. In terms of guidance, you have revised the guidance from around 23% for 20% for the calendar year 2012, largely because of problems in North America and slower than anticipated pickup. Can you give us a sense about what really is the issue in the long term? Is it North America or Europe, which of course is also volatile?
Well, thanks for having me again. Let me start with our first quarter. We had a very solid first quarter. We exceeded our guidance that we set for the first quarter. We grew 2.9% sequentially compared to the prior quarter. And so we feel good about, and our growth in the first quarter was, the growth we had in the first quarter was broad-based across our industries. Having said that, as we came into the second quarter, as you mentioned, we didn't see the acceleration in growth that we typically see at this time of the year. Our second quarter, while we saw some acceleration picking up coming into the quarter, that acceleration was not as strong as we would have expected, which led us to take a more conservative approach and take our full year guidance down from to at least 20% for this calendar year from the prior guidance of at least 23%. The weakness that we saw was principally in two areas of our business. It was in the pharmaceutical portions of our healthcare segment, and it was in the banking portion of our financial services business, both of those largely in the North American market.
Okay. In terms of, geographical demarcation, Frank, by when do you expect North America to pick up? Because that's been a concern, and that's probably the reason why several of your peers have also indicated a tepid outlook. By when can we see that picking up?
I want to make sure that we characterize our view of North America and our view of the business in the right way. Our guidance of at least 20% for this year, we still think is a very healthy growth outlook. As you know, a large portion of our business comes from North America, and so we think that there's still a healthy demand in North America. We continue to win business in North America. We continue to grow ahead of many of our industry peers, both in North America and across the rest of the world. Having said that, it is a volatile environment out there. I think that in Europe and increasingly in North America, our clients are examining spending carefully, and they're being prudent in how they're spending through 2012, given the volatility. And so I expect that we will continue to see that through the course of this year. We've taken a cautious approach to our guidance as a result of that, but we still think that 20% is very, very solid growth given this environment.
Absolutely. What about financial services? Do you continue to see pressure for the next 2 to 3 quarters? As in for the full year, will banking and financial services remain under pressure?
When we look at our financial services segment, it's a mixed story. In the banking portion of our financial services segment, we saw flat growth in the first quarter, and we expect, and baked into our outlook for the full year, we expect that financial services, or rather that the banking portion of financial services will underperform the company as a whole for the rest of this year. However, when we look at the insurance side of financial services, we had a very strong quarter in the first quarter, and we expect that insurance will grow better than company average in the coming quarters.
Okay. Frank, on the margin front, you've always been targeting margins to come in at between 19 to 20%, and you've actually exceeded that for the quarter. But for the next quarter, for Q2, you will be absorbing wage hikes. So can you give us an idea about what will be the impact of wage hikes on margins? Have you factored that yet?
Absolutely. We came in slightly ahead of our target range of 19 to 20% on a non-GAAP basis. As we said on the call, this is a normal seasonal pattern for us, and it prepares us to absorb the wage increases that we expect will impact us in the second quarter and to some extent in the third quarter. And so we would expect that in the second quarter our operating margin would come back into the range of 19 to 20%, which would allow us to deliver within the 19 to 20% range for the full year after we've absorbed the impact of the wage increases.
All right. In terms of pricing, Frank, pricing has been stable for this quarter. Going forward, any possibility of an uptick in pricing, or do you foresee a marginal decline going forward?
No, our view right now is that pricing is playing out exactly as we predicted. Pricing in the first quarter was flat, and we expect that for the full year, pricing will remain flat with perhaps a slight upward bias.
Okay. I'm going to go a little bit onto the pharma and healthcare side. The healthcare portion of your business has seen a little bit of a mix in terms of its trends. While the peer side has actually grown, pharma has declined. Give me a sense, will the healthcare segment as a whole, considering it's your second largest vertical, be in line with company average or exceed company average, or will pharma be a little bit of a pressure point there?
We think that, as you pointed out, that pharma will continue to be under pressure for the remainder of the year. We saw our pharma segment actually, the pharma portion of our healthcare segment actually declined in the first quarter by about 4%. That's an unusual decline. We normally see in the first quarter that pharma is generally flat, perhaps slightly up, but this quarter we actually saw a decline, which was unusual. And so we expect that over the course of this year that our pharma business will lag the company in terms of growth. However, as a sector overall, we're still very optimistic about our healthcare sector. The payers are doing, our business in the payer sector is doing very well. That's driven by regulatory changes. That's driven by some new discretionary work that we see coming on in the payer sector. And so overall, we think that the healthcare sector will perform well for this year.
Okay, Frank, quickly, currency volatility is, of course, an issue for IT companies. It's been affecting numbers in the last 2 to 3 quarters. Does your hedging position for the next 1 year remain the same?
We continue to be active in the hedging markets. We have a very solid hedge position for the rest of this year. And we're continuing to increase our hedge positions as we look out 2, 3, 4 years, because we think that this helps us in terms of managing some of that volatility, as you pointed out. So we'll continue to do that. We think it's a good business strategy and it makes sense for our business.
Okay. Frank, on the consulting side of your business, consulting has actually performed higher than company average. BPO has also performed very well. In terms of your business segments, can you give me an idea about the next 1 year? What will really be the driving factors, consulting, BPO, infrastructure, amongst these business units?
Well, certainly what we are calling our Horizon 2 businesses, which are BPO, IT infrastructure services, and our management consulting business. For some time now, these, as a group, have been leading the company in terms of growth. These are businesses that we've invested in over the last 4 or 5 years, and which are now have now reached critical mass and are growing faster than company average. We're very pleased with our progress in each of these businesses. Our BPO business, our approach in that business to being very industry focused, driving deep process knowledge into each of the service offerings that we offer is resonating extremely well in the market, and we've had several very large wins recently in the BPO business. Similarly, the management consulting business continues to grow from strength to strength. We now have 3,000 people in that business, a very strong management consulting front end, which is really important for our clients as they deal with changing industry dynamics in their businesses. Our management consulting team is able to go in and work with them both on innovation and on cost containment initiatives.
Okay. My last question then to you, Frank. You've revised your repurchasement program, your share repurchasement program, from $600 million to $1 billion. Could you tell us what's the reason for that?
Well, we think that we have a lot of confidence in our business going forward. We think that our share repurchase program is a solid way for us to return cash to shareholders. We are generating a significant amount of cash, and our board of directors has approved an increase in our share repurchase program from $600 million to $1 billion, both as a way to demonstrate the confidence that we have in our business and in a way to prudently return cash to our shareholders.
All right, Frank, thank you so much for speaking to CNBC TV 18. So as you heard Frank point out, Cognizant seems bullish. There are, of course, several concern points from North America to BFSI to a possible concern in the volatility in the currency. However, Cognizant remains confident, and as far as this quarter numbers go, currently Cognizant is well placed to beat its peers. Thanks for watching.